It is that time of year again. We have all the hyperscaler reports in hand. So let's do an update on their capital expenditures or CapEx numbers through Q2 2026. As we've been discussing now for a few years, this has become the driving force, the demand that is propelling this bull market, the semiconductor-driven bull market. Have things changed? Let's talk about this because obviously there's a lot of noise after a lot of semiconductor stocks have crashed in recent weeks. We're still looking at very high double-digit or triple-digit returns for some of them year to date, so it's not really a crash. But has anything fundamentally changed? The simple answer is no, and we'll talk about why that is. A quick shout out to our friends at Fiscal.ai, the sponsor of this video. Use their charting feature to put together the CapEx numbers for the hyperscalers, plus decided to throw in Tesla for fun on this one since they're also building data centers these days. And on a trailing 12-month basis, here you have it. Nearly $580 billion spent over the last trailing 12 months across these companies. And if you also toss in SpaceX, which will be reporting on Tuesday, August 4th, the expectation is now for about $890 billion in total CapEx for 2026. If you need quality data like this for your investment journey, Fiscal.ai has you covered. Check out fiscal.ai/CSI to get 15% off any paid plan. Again, $580 billion in trailing 12-month CapEx across Amazon, Microsoft, Google, Meta, which is now getting into the proprietary closed-weight AI model business, Oracle, Tesla, as well as SpaceX. And that number expected to be $890 billion. Let's just call it $900 billion, perhaps a little bit more, possibly getting spent this year on capital expenditures, primarily for AI data centers. At CSI, we believe this number is possibly headed towards 1.5 trillion in 2027. At least that's what it appears it will work out to be as of right now, here at the beginning of August 2026. This has done quite the number on the hyperscaler free cash flows. A couple of these companies have now dipped into quarterly negative free cash flow the last couple of quarters. Amazon has joined Oracle in that, and everybody else, the free cash flow has been restricted or is actually in decline because of that heavy pace of CapEx. As we've covered the last few quarters, this is obviously not a sustainable rate of capital expenditures. This is full-on, all-out growth CapEx cycle in support of what these companies are saying is a very long backlog of compute expected from their customers. Another look at this chart that we've been discussing for a couple of years now, CapEx to revenue ratios, again, just illustrating the lack of sustainability here of this CapEx. We fully expect this number to eventually, perhaps later this decade, to begin to moderate as the companies pull back on that CapEx and return to more robust profitability growth for their shareholders, including on a free cash flow basis. Oracle, very much the big outlier here, sort of more like a neocloud on a trailing 12-month basis, spending nearly all of its revenue on CapEx the last few quarters. But the big question remains for many investors somehow, why? Why are they doing this? What is the reason? This is the reason why. For the sake of simplicity, I've excluded Meta and Tesla from this chart, just looking at the major hyperscalers plus Oracle. This is their trailing 12-month cloud revenue through Q2 2026, collectively now at nearly $400 billion in revenue. Amazon AWS still in the lead at over $148 billion on a trailing 12-month basis. On an annualized basis, they're fast approaching the $200 billion mark. Microsoft Azure and their total intelligent cloud business at $138 billion, and Google Cloud at nearly $78 billion in trailing 12-month revenue. Oracle has both cloud infrastructure and software revenues. The infrastructure portion is the one that nearly doubled year over year during their last quarter, reported a couple months ago, but in total at $34 billion on a trailing 12-month basis. They're all reporting significant backlogs that will take them the next few years to work through. Amazon AWS, the last one that reported on Thursday, indicating in their earnings call, they think AWS all by itself can double from here over time, if not reach $1 trillion in annualized revenue all on its own, which is pretty incredible considering Amazon, including the whole business, including e-commerce and everything involved in that segment of the business, already pushing towards $1 trillion in total revenue, perhaps within the next couple of years. Now, I know measuring the profitability of capturing this revenue is controversial. There's a lot of different ways you can measure it. Free cash flow, not so meaningful a metric given the high CapEx, and we don't know when that CapEx will ease and allow revenue to sort of catch up to all the infrastructure that has been invested in and built, or if revenue just continues to accelerate through 2027 and maybe it just organically catches up to the infrastructure spending all on its own, kind of like Google Cloud, and it's some 80% plus year-over-year growth rate in Q2. On this slide, I have EBITDA, earnings before interest, tax, depreciation, importantly, the D in that acronym, and amortization, projected out through Q3 of 2027. Also a controversial metric because it excludes depreciation expense, depreciation being the depreciated schedule of the infrastructure that has already been paid for, the CapEx, depreciated CapEx. It is depreciated over the course of, on average, about 5 years now at this point. For some of the hyperscalers, a bit more. But excluding that line item, you can see the nice, steady, expected increase in EBITDA profit through the next year and a quarter. But if you add that back in, GAAP net income also leaves questions as well because of the big depreciation number. All the CapEx expense is going to be depreciated over the course of the next half a decade or so, and that leaves investors wondering just how profitable can these companies be due to the sheer size of this CapEx boom. This is really messy, but as far as we can tell, at least the hyperscalers' businesses are supporting this CapEx outlay that they keep talking about and keep raising the bar for. Now, $900 billion for this year, and we think possibly headed to $1.5 trillion in 2027. Time will tell. We still think the hyperscalers offer good diversification within a portfolio, sort of a CapEx hedge, if you will, against the semiconductors, which is where the majority of this CapEx is headed. In fact, some of the recent CapEx increases, like Amazon raising their full year 2026 CapEx guide from $200 billion to $220 billion now, is due to memory prices going up. So all that revenue continuing to go straight to the semiconductor companies. This is why we think the semiconductor market is far from finished. It is still the primary beneficiary of all of this AI data center build out. And what just happened is not a crash as much as it is a large mid-market cycle of some sort, unwinding of leverage, really extreme leverage. But at least as far as the data appears right now, this thing is not over. Now, just a final point I want to walk through. I want to call out this chart here that we did an extensive deep dive into the macro trend behind all of this last month. But here's just one look, one estimate at the total IT sector, global IT sector spending from Gartner. This is direct IT spending, not the overall digital economy. Back in April, they were projecting something to the tune of $790 billion in data center system spending, about a 56% year-over-year increase. And if you look at 3 line items below, they still had IT services just kind of all lumped together in one line here, a 9% year-over-year increase at nearly 1.9 trillion. IT services encompasses a lot of different things: outsourced service, software services. It's the biggest line item. And for a while now, we have been calling out this is the line item that is possibly getting disrupted long-term by infrastructures, by new types of infrastructure like AI data centers, the first line item that Gartner has listed. Lo and behold, here at the end of July, Gartner did their own update. They've now bumped up data center system spending to over $820 billion, about a 63% year-over-year increase. Why is that lower than the hyperscaler CapEx that we just rattled off? It's because a lot of that CapEx is not directly for data centers. For example, remember Amazon has CapEx primarily for AWS, but there is a sizable but minority share of that CapEx that also goes to their e-commerce business, like warehouses and such. So that obviously would not be included in here. Notice now there is another line item listed, broken out of, and listed below the services. Services is now seemingly shrunk to under 1.6 trillion in expected spend, about a 5.3 year-over-year increase. But below that, infrastructure as a service, services basically supported by new infrastructure build out like AI data centers, has been broken out of services overall, now listed separately at $287 billion in end market spending for 2026, a 29% year-over-year increase. And so that would be infrastructure spending for new AI-powered software. This is what we have stated all along, is our belief that a lot of legacy IT sector spending is suddenly incentivized more than ever to migrate to some sort of cloud, remotely accessed compute, centralized compute workload more than ever before, far more incentive than existed in the 2010s or even during the early 2020s, during the pandemic and lockdowns when everybody sort of went digital there briefly. AI is opening up new workloads for a lot of new sectors of the economy, a lot of new industries that it did not touch before. And so a lot of this is now migrating to these new modern infrastructures and pressuring legacy IT services. A lot of that growth now getting mopped up by infrastructure as a service and a lot of support offered via things like your favorite LLM, OpenAI or Anthropic. We think this trend has a long ways to go, at least a few more years. It's going to be bumpy, just like the end of July was very bumpy. August likely to be bumpy as well. But the underlying trend of this bull market remains intact. Infrastructure is in. Companies all over the world are investing in it or offering money for the hyperscalers to invest in it for them so that they can rent it down the road. And that is propelling the semiconductor industry. That will do it for this quarterly update on the Hyperscaler CapEx. Make sure you stay tuned, hit the subscribe button for all of our videos so you don't miss one. Been getting a lot of comments as to what y'all can do to make sure YouTube actually tells you that we release a video. The algorithm has moved on to much more trendy, boom-busty topics as of late. So if you want to get us to the top of your feed, hit subscribe, hit notifications. Also, don't forget to check out fiscal.ai/CSI for 15% off. While you're here, if you're looking for another video to watch, check out this one we recently did on Seagate Technology, one of the memory stocks in our memory basket within our portfolio.